When people are coping, a lot of staff are complaining about air quality is affecting you guys.
No, but in other rooms it is bad though.
No, it's some problem with the dump. Find there was some issues.
Okay.
It's not affecting you guys. It's just
Well, you're talking about inside the rooms?
no, just
No?
in and around.
Okay.
Morning, how are you? You here, Ben?
Yeah.
You sure? When some come, then so.
What do you call it again? Quantitative methods. You're not here. Running. Transport. Shabo, you finished? Okay, I know. Embarrassingly behind. It's real bad. It's like I'm last. Laptop fix? Laptop fix? Your laptop fix? See my hair. Yeah, I know. She, I heard, I see the message. Because I don't want to come back next semester. Alright, well, oh Jesus. And it's not been offered in summer either. So I really need to come.
Okay, so good morning, everyone. So today we want to get into cost of capital and capital raising. And we're going to center discussion around, so we have Harvard Business School case study, globalizing the cost of capital, and the spreadsheet supporting that. So I'm going to start with that. And then there's the Harvard Business School comprehensive reading, cost of capital. So again, this cost of capital reading, you can think about as the equivalent of your textbook chapter on this particular topic. And we will come back and look at this maybe next week after we've gone through something. Maybe we might get with this week. Then it comes with a bit of a theoretical discussion and then a fairly detailed example working through the weighted average cost of capital for Coca-Cola. So this is your responsibility to do. So I want to introduce or remind you, set up some of the issues around the topic with this case study, globalizing the cost of capital and capital budgeting at AES. So you've been doing time value of money. You've done capital budgeting. And in all of those exercises, the discount rate was a critical factor. Okay? Where did that discount rate come from? Why that particular discount rate? So the weighted, so in most cases, so when you're doing NPV, what is the decision rule with NPV? Okay, so you accept the project if the NPV is positive. And in calculating the NPV, one of the biggest factors is what discount rate you use. And with the IRR, what's the decision rule with the IRR?
something about.
You accept if the IRR is greater than the discount rate. Greater than 1 is the profitability index, if you do the profitability index. So the IRR, you would accept the project if the IRR is greater than the discount rate. So again, where did that discount rate come from? And that discount rate that you use to do the NPV, the rate that you would be comparing the IRR to, is the weighted average cost of capital. So you can think of the WACC as the investor's required rate of return. Okay, so you can think of the weighted average cost of capital as the investor's required rate of return. So investors put their money in a venture, in a business, and they make an assessment as to the risk of the business and what rate of return they would require to compensate them for this. So you can think of the WACC as the minimum rate of return required by the investors, sometimes just called the hurdle rate. They're basically saying to the management of the company, do not take my money and invest it in any projects that are expected to generate a rate of return that is less than the WACC. So through WACC, we actually end up covering quite a bit of ground in terms of finance concepts. So this is should be a familiar formula for you. And the definitions, I think, are important, and helping you to wade through information, whether it's a problem for tutorial, an exam problem, or even trying to apply it in real life. What are you looking for? So how many variables are in that equation? How many variables are in there and what are they? And it's important to identify that and to know precisely what they mean. How many variables? Come on, Alicia, you're breaking my heart. Two? Not quite. A tad more than 2.
7? I don't know.
You're guessing. How many you see there? There are 5 variables.
5?
There are 5. What are they? You have the E on V, and the D on V, and you have the R sub E, R sub D, and then you have the pi, which is the tax rate. So there are really 5 things that go in there. So there are 5 variables. These are kind of outlined there. So the target capital structure. So the first set of variables we want to focus on are what we call the target capital structure. How do the investors want to finance this project? Which is really the percentage, the mix of debt and equity financing. So target is this is where you would like to get. This is what you would like to do. The target capital structure. So the E on V is the percentage of common equity financing that the firm wants to use for the project. So the E on V is the target, the desired percentage of common equity financing that you want to use for the project. And the D on V is the target percentage of debt financing you want to use.
I can ask what the V stands for again?
So the V is the total value of the project, how much? Right. So you're buying a car, $100,000 for the car. So that's the V.
Total value.
How are you planning to finance getting the car?
Right.
So the bank might lend you 80%. So your D on V is 80%. So the bank would lend you 80,000 out of the 100,000. So 80% of the financing is coming from debt. Therefore, that means that 20% is coming from you, your equity, your E on V. So E on V plus D on V must add up to 1. They must add up to 100%. If you're borrowing 40% of the money, if your D on V is 0.4 or 40%, then your E on V has to be 60%. Is that clear?
Yes.
I guess the people who have done FM1, sometimes it's always a little troubling what they don't see.
Okay.
So you don't see preferred shares. You should remember this from FM1. Yeah, so you don't see preferred shares in the example because in practice, preferred shares are not a popular form of financing. Why not, anybody? Why do you think in practice that preferred shares are not a very popular form of financing? And if somebody offers you to invest in preferred shares, that you should think twice about using preferred shares. So if you think of 3 forms of finance: debt, you can lend the money, right? Preferred equity and common equity. Why is preferred equity not terribly popular among investors?
So you don't have any voting rights on the company, maybe?
Okay, they don't have voting rights. Okay, but neither does debt.
Okay. I thought you couldn't vote.
No, people who lend money don't have voting rights. Who has voting rights?
Shareholders, right?
Common shareholders.
Common shareholders.
Okay, the common shareholders are the true owners. They are the ones with voting rights.
Yeah.
My jump so you can have a suck at this. My mother always said if you put your back on the ground.
Never.
You all have to do that here. Put your back on the ground, you're gonna end up poor. I'm gonna crowd you up. I can't afford to get poor. But as an investor, preferred versus common. Or preferred versus debt. So let's think about it as so. So if you think of the 3 of them, who gets paid first? Of debt, people who lend money, preferred and common. Who gets paid first? The debt gets paid first. So question might be, so why don't I lend them the money? Because debt has some clear advantages. They're gonna get paid first. And their money is due whether the company makes a profit or not. If you lend a company money, you're a debt investor. How much revenue they make is none of your business. Your contract with them doesn't allow them to come and cry to you and say, well, things rough, we can't pay you this month or whatever. The debt investor is an absolute claim. And if they don't pay, you can take them to court. So from that viewpoint, the preferred shareholder comes after the debt. But they get paid before the common. So you can think about it. If the company does very badly, if things go bad, which type of investor do you prefer to be? Debt, preferred, or common?
When things go badly?
If things aren't going well, sales aren't great, costs are higher, which type of investor you prefer to be? Which investor is better protected in that environment? Debt, because he or she is supposed to get paid
first,
regardless, and it's a kind of fixed amount. When you lend, you know what you're gonna get back. If things go very well, the company is doing super well. Which type of investor do you prefer to be? Where would you prefer to be? Preference? Why would you prefer to be preference than common if you're doing well? Yeah, preference get paid before the common, but there's another little caveat there, that's a big, turns out to be a big thing. Because as a preference shareholder, I thought I heard somebody say something.
Obligation. They're obligated to pay.
You're obligated to pay, but as a preferred shareholder, you get paid a fixed amount. So even if they make $10 million in profit, you can't get more than, let's say you are 6% preferred shares, or 9%, then your dividend is capped at 9%. Whereas the common shareholder, the amount available to them is unlimited. So when the company is doing very well, the common shareholder, so let's just put some fairly simple on that. So if we look at two scenarios. So let's EBIT. You get to your earnings before interest and taxes. So EBIT is $1 million versus EBIT of $100 million. We have two scenarios. So if you are a debt investor, what do you get paid? What is your return?
Plus interest.
Interest, right?
Mm-hmm.
And if you're a preferred investor, then you get paid a preferred dividend. Then you get common dividend or common. So let's say the debt. The debt is a loan of $5 million. At an interest rate of 8%. You have pref shares, let's say $5 million. Is that $5 million? And they carry a dividend of 12%. Carry a dividend of 12%. So how much would the debt investors get in that year? What are they entitled to? 8% of 5 million. So 400,000 is what they're gonna get. So that's gonna leave how much now? That's earnings before taxes, right? So it's $1 million minus 400,000, so 600,000 is left. Who next has to be paid? You have to pay your taxes, right? Okay, so tax rate, what's the corporation tax rate in Antigua? I think about 25%? 25%. So government is going to show up for their 25%. So that's going to leave how much? So I'm going to make my scenario a little different. So after taxes, how much is left? 75,000? And then who gets paid next? The preferred, and what are they entitled to? 12% on their 5 million. Can they get paid that in that year? So they can't get paid. So even though it's called preferred, you only get paid if there's enough. So they can't get anything. And what do the common shareholders get in a year like that? They can't get anything either.
Nothing.
Or let's say the most the preferred could get is, let's call it, the most they could get is 75,000. because you can't pay more than profits for the year. Now so the business doesn't do bad, does pretty badly. What if it does really well?
I think it's the other end. The other end. It's not.
Try to start touching it.
Okay.
What if things go really well? How much do the debt investors get? They're going to get the same 400,000. Huh? So you can think that as a debt investor, you get that protection on the downside. Even if things get bad, then you get your same amount. But on the upside, you are really not the beneficiary of that. Okay, the tax man is very happy. He's going to get 25% of that. So the tax guy does very, very well. How much are the preferred shareholders going to get? 12% on the 5 million, so they're only getting 600,000. And how much is left for the common shareholders? 74.1. So we often see that preferred shares are a kind of halfway house. You don't have the protection of debt on the downside. Does that make sense?
Yeah.
But you don't have the benefits of common on the upside. So it's like a kind of a middle of the road that doesn't seem to serve anybody well. If you're an investor and you want a guaranteed rate of return, and you want all of the protection, where's the best place for you to go with your money? Okay, so again, if you're an investor, you're very concerned about risk, and you want a guaranteed rate of return, then you're better off going in the debt camp. If you want to take some risk in return for the potential for return, then you prefer equity. So we tend not to see common equity that much in practice. So coming back to the WACC equation, so 2 of the 5 variables are the target capital structure. How does the company want to finance its operations? How much of the financing it wants to come from common equity, and how much it wants to come from borrowed funds. So again, if you're looking through any information, a problem, anything with WACC, you must have this information. You must be able to figure out what the capital structure is. Percentage of debt, percentage of equity. Then we have the RE and the RE. So the RD is the cost of debt, and the cost of equity. So this is RD, cost of debt, and RE, cost of equity. Okay, anybody cost of debt, what do you understand that concept to be? What are you trying to measure? How you explain the words?
How much interest you're gonna have to pay?
Okay, how much interest you're gonna have to pay? So from your D on V, you say, I want to borrow $80,000. So the cost of debt is the rate of return that debt investors require. So you're gonna go to your debt investors to raise $80,000. What rate of return do they require for investing in you? So with the cost of debt, what we're trying to capture is that if the business went to the capital markets to borrow new money, and that's important, that the WACC, everything in the WACC there is a forward-looking measure. Huh? So it's the target capital structure, not necessarily your existing capital structure. Okay, so that's an important nuance to keep in mind, that the WACC, everything in there is forward-looking. It's your target capital structure, where you would like to be, not necessarily your existing structure. And then the cost of debt, if you went to the capital markets to borrow new money, what interest rate would you likely have to pay on it? What rate of return would debt investors require for investing in your business? Therefore, by extension, the cost of equity would be measuring what? How would you define the cost of equity?
The interest that you're
I
gonna
know you want me to come close to you, but go ahead. Okay, dividends, but that's only part of it. Part of it. So dividends, so common shareholders. So it's the rate of return that your common shareholders require. You're gonna go to your common shareholders for some new money. What rate of return do they require for investing in you? So it's important to keep in mind that when you buy common shares, your return comes from two sources. I guess it's the next topic, but that's dividends, plus you can make capital gains if the value.
Oh, okay, got it.
And then we have the tax rate. So as I was saying, if you're looking at a problem, or any case study or any real life situation, then the information must allow you to figure out those 5 things. What is the target capital structure? What percentage of debt? What percentage of equity financing? What rate of the cost of debt? What rate of return do debt investors require? The cost of equity. What rate of return do common equity investors require? And your tax rate. Now, I mean, a lot of finance theory is about RE and ROT. Who's about to speak about that? So how do you estimate these things? If I Violence Campus were to go to a bank to try to borrow some money to make sure people don't have to move around desks and classrooms are properly equipped, what interest rate would the bank charge us? How? Or you are on the other side, you're a banker, somebody comes in for a loan. How do you determine what interest rate you would charge them? So there are different ways to think about it. So in finance, we tend to think of things a lot in terms of spreads. So one way we think of the cost of debt equal to R sub F, which is the risk-free rate. Risk-free rate plus a default spread. Okay, RF, risk-free rate, anybody, what do you understand by that concept? And why might we set it up like this if somebody is coming to borrow money? Risk-free rate, what do you understand by that concept?
It's the rate at which the government treasuries are set.
Okay, so government treasuries, okay, so that's an example of what is used, but it's still a broader definition, risk-free. So who is the safest borrower in the economy? The risk-free rate is the interest rate you would charge to the safest borrower in the country, the borrower who has the least risk of default. So the idea is, if this young lady came in to borrow money from me, I need to set an interest rate on her loan. I would be an idiot if I charge her a rate less than the risk-free rate. Why? Because in theory, she has some risk of default. But I could lend the money to that risk-free borrower and be guaranteed I would get my money back. But the fact that she's not risk-free, she has to pay something on top. She has to pay a spread or a premium. Okay, so RF, so you take the risk-free rate as a base, as a benchmark. What is the rate that the government so what might be, so you're trying to set a rate in Antigua. So if we go to the Eastern Caribbean, Securities Exchange. So if we have here, let's see. So can you all see that from down there? So 24th of February 2025, the government of Antigua and Barbuda borrowed $30 million with 365-day treasury bills at a rate of 4.5%. So if you think of the government as the safest borrower in the economy, you would see, so in terms of applying this equation, then you might say, okay, anybody else coming, so I'm ACB or any bank and I have some money to lend out. I can buy government treasury bills, get 4.5%, it's almost guaranteed. So anybody else coming to borrow that money is gonna have to pay something extra on top of it. So, sometimes people often ask, well, why do we think of the government as risk-free? Sometimes you get a kind of skeptical response to that. And I mean, in a sense, it's no way a statement that about whether the government is competent or managing well. Just that the government is the sovereign. The government has options that other people don't have. So why do we think of the government as a safer investment than Hadid? Let's take an Hadid example. Why would we think of the government as safe? Because if Hadid borrows money from you to pay you back, where do they have to get money from? Where do they get their money from to pay you back?
With profits and so on.
You know, they go sell cars, etc. I mean, you don't have to buy a car. You don't have to buy it from Hadid. But you can't choose legally to get your driver's license from somebody else. I mean, governments get their revenue from taxation, and they have unlimited capacities to tax within their domain. So you can't choose. If you're an employee, you can't choose not to sign up for medical benefits. You can't say, I'm going to buy my friend around the road and get a passport from them. Okay. Or you can't legally choose not to pay your taxes. So governments have that unlimited, so that's why we tend to see them as risk-free, because they don't have to earn any money. They can just come and take it from you by passing a law in Parliament. So by looking at the rate on government debt, you can get a risk-free rate. And then you have a much more difficult problem, which is the default spread. That's actually a much more complicated issue. How much extra should I charge to compensate me for the risk of lending to Green Apple? How much riskier is Green Apple than the government? How much extra should I put on top of that? And that's a little bit beyond our course. So you'll be given that default spread. That's the answer. You can think of it like car insurance. I mean, so it's not intuitive. So if a 40-year-old who has been driving for 30 years, well, that's too long. No, that's too long. 20 years. A 40-year-old driving for 20, 22 years and they've never had an accident. If they go in for car insurance compared to an 18-year-old with a brand new license, is the insurance premium going to be the same? Why not though? Why not? Why isn't the insurance premium the same for the 40-year-old with a 22-year history of no accidents versus an 18-year-old with a brand new license? Why is the premium not the same? The risk of having an accident and the insurer having to pay out a claim is assessed very differently. So they want a higher premium to compensate them for the higher risk associated with the 18-year-old. Same principle here. Okay, so if Hadid goes into the bank for a loan today, he's not gonna get charged the same rate as I would. Okay, just a very, he can put up more collateral, different risks, and so on. And then we have the cost of equity. How do you estimate that? By far the most difficult problem, difficult issue. If you were to buy shares in ACD, what is a good rate of return? What is a fair rate of return? If you were to invest in an Airbnb or a taxi, what would be a good rate of return on your money? What would be a fair rate? Which is really what the cost of equity tries to measure from, and this should be a very familiar equation to you guys from FM1. Familiar? Seen this before? No? You've never seen CAPM in your life?
Shall I?
Oh, she's not taking me on this one. Too sleepy? Okay, so what do we have? So again, it's the same thinking. If I'm thinking of putting my money in ACB shares, and I'm thinking through what would be a good rate of return for my money. So how are you being kind of sort of taught to think about it? I can put that money in government treasury bills and get 4.5%. I can go to sleep, I don't have to worry about it. I go to the beach and I just get my stuff. So that's my benchmark. I start off with the risk-free rate. And then I need to add something on top of it to reflect that risk. So what are those other three variables in there? Well, two variables. We have the risk-free rate in there already. So in the bracket, so what do we call that bit in the bracket? RM minus RF, what do we call that? Okay, the market risk premium or the equity risk premium. Either name, market risk premium. And what does it try to measure, anybody? What is the concept behind it? What is it trying to tell you? Digging back in the brain. I know you put it all out on the exam and you didn't keep. So the RM minus RMF, or the market risk premium, also called the equity risk premium, it basically says that on average, in a particular economy, so let's say we're in Antigua and Barbuda. In Antigua and Barbuda, when people move from something safe, which is RF, so if you invest your money in something safe, you're earning RF. When they move to something risky, which is what RM captures, the rate of return on your average or typical risky investment, how much extra do they earn to compensate them for? So as persons move from safe to risky investments, on average, how much more do they earn? So if we said the RF was 4.5%, and if RM was 12%, then the equity risk premium is 7%, 6.5%, 7.5%. So it says in Antigua, when you move from something risk-free, so RF captures something that is risk-free. RM is the rate of return on an investment of average risk. Okay, so when you move from, so if you invest in something risk-free, in this particular economy, you earn about 4.5%. When you move to something of average risk, you tend to earn around 12%. So the equity risk premium for this economy is about 7.5%. As investors move from safety to above average risk, they require an extra 7.5% of return to compensate them for taking on that extra risk. Without stating the obvious, I'm assuming that investors are risk averse. The next topic, we will try to tie down exactly what we mean by that. Risk averse simply means that if investors are going to take on more risk, they're going to require more return to compensate them. It's not that they don't like risk, or that they won't take risk, but they expect compensation. And then the B is what then? The B is the equation. Okay, beta, and more precisely in our context, is the equity beta. So you're thinking of investing in shares of Antigua Commercial Bank, and you're trying to figure out what would be a good rate of return on this investment. How would I know that this management is compensating me adequately? So I said, okay, I know I can put my money in, and I can go to ACB itself and talk to my branch manager and say, well, you know, I want to, some of that money I have on the bank, I want to put it in Antigua government treasury bills through the regional government securities market in syndicates. You want to hire some of you, so that's an option you want to look at. The Caribbean Central Bank is very concerned that Antiguans are underrepresented among their staff. Apparently Antiguans just don't ever like to leave Antigua. And they would like to hire more of you. So I need at least 4.5% to invest in ACB. Because I can get 4.5% just risk-free. How much more than 4.5? I know if I put my money in something of average risk, I can earn 12%. So the equity beta, what does beta capture in this context? What do you understand by beta? Anybody? Beta.
You said beta is something with volatility, measures volatility in the market.
Measure of risk volatility. But risk volatility relative to what? So it's how risky or how volatile a particular investment is relative to RM or to the market. Okay, so beta is really looking at risk in a very relative context. How risky is this investment relative to the overall market? How does this risk profile compare to RM? So if your beta is 1, if when you calculate the beta, the number is 1, what is that telling you? If ACB's beta is 1, what is that telling you about ACB?
Repeat that.
I say if ACB's beta is 1, what is that telling you about ACB? What does it say about it in terms of their risk relative to the market? But it behaves exactly like the market. If the beta is 2, what is that telling you about ACB? It's twice as risky as the market. It's twice as volatile. If the beta is 0.5, what is that telling you? It's less risky than the market. In fact, it's half as risky. So using CAPM then, using this equation, what rate of return would you require for investing in ACB? So we have all the inputs there. So ACB. What if the beta is 1? So it would be What does the equation tell us? The equation says the cost of equity is equal to what? The risk-free rate, which is what? 4.5 plus beta times RM minus RF. So beta, what is the beta? The beta is 1. Plus the beta multiplied by RM minus RF, which was how much? 7.5? So what would be a good rate of return for ACB if its beta was 1? 12%. Because the beta of 1 says it behaves exactly like the market. So we can break that 12.5% into 2 bits. The risk-free rate, which was 4.5, and we want a risk premium. What is the risk premium? The risk premium is RM minus RF times the beta. So you want a 7.5% risk premium, which then gives you that 12%. Because ACB's beta being 1 says ACB has the same risk as the market. So you would want the same market risk premium. What if ACB's beta were 2? What might be the required rate of return? Same formula, we want the risk-free rate, we want the market risk premium. So what's the risk premium? It would be RM minus RF, which is 7.5, right? Still the same, multiplied by the beta, which is now how much? So what risk premium do you now want for investing? When the beta was 1, how much extra on top of the 4.5 did you require to invest in ACB? When the beta was 1. Okay, when the beta was 1, you know that you need to get the 4.5. That's your benchmark. That's your base, right? This is your base. And then you are adding on your premium. The premium is the beta of the asset times the market risk premium, right? Everybody following that? Everybody good with that now?
Can you repeat it for me? Repeat it.
Sorry?
Can you repeat it for me?
Okay. So you have $10,000. You say, okay, I'm not going to spend it on wine, woman, and song. I'm going to invest it.
Right.
And I want to put it in some shares of my Antigua commercial bank.
Okay.
And you're thinking, okay, if I put the money there, what would be a fair rate of return on that investment? How would I know that I have invested my money well? What rate of return would be adequate compensation? So I have a framework here called the capital asset pricing model, very famous equation in economics. Nobel Prize, they won a Nobel Prize for this.
Okay.
So it says start with your risk-free rate. You know you can put the 10,000 in Antigua government treasury bill. Antigua isn't going anywhere, the government might change, but 50 years from now, unless climate change, Antigua will be here, so you will get your money. So that's your base, and then you want to add a risk premium. And your risk premium is the beta times the market risk premium. So what if the beta is 1? So the risk-free rate is 4.5%. The RM, the return on the market, or the return on an investment of average risk in Antigua is 12%. Therefore, your equity risk premium is 7.5. What if ACB's beta is 1? When you plug into the equation, you're gonna get 12%. Why we get 12%? Yeah. Risk-free rate, 4.5, plus beta 1 times RM minus RF. 1 times 7.5 is 7.5 plus 4.5 is 12. So we can break that down into two pieces. 12% is the risk-free rate, 4.5, and then what is the risk premium? The risk premium is the market or equity risk premium times the beta. Now what if the beta is 2? Then RM minus RF is 7.5 times 2, it's 15. So now you want a return of 19.5%. Why is the risk premium 15 instead of 7.5? ACB's beta being 2. What does that tell us about ACB? The returns on ACB stock are twice as risky as the market. So logically, very simple model, I want a risk premium that is twice as much. I don't want 7.5. How much do I want? 15. I want twice as much. So 15 plus the 4 gives me 19.5. What are the implications of this for NPV IRR? Because if this is your discount rate is now bigger. What does it mean for a project? If the cash flows are the same, a higher discount rate is going to be what? The NPV is going to be smaller. If you're comparing your IRR to this to decide whether to accept or not, then it now has to earn a higher rate of return. What if the beta is 0.5? If ACB's beta is 0.5, what is that telling you about ACB as an investment? Sorry? Yeah, there's less risk. How much less risk? Okay, so let's get a little precise, because I want you to get an A. I want everybody to get an A. If you tell me less risk associated, then that's only going to give you like 50%. So less risk associated with what? Or relative to what? Okay, so it's less risky than the market. The fact that the beta is less than 1 tells you that the returns on ACB are less risky than the market. And how much less risky? Half as much. So we can actually quantify it. So if you wanted a 7.5% risk premium for investing in the market, what premium would you want for something that is half as risky as the market? It should be half as much, right? So 0.5 times 7.5. So you would want 3.75. It is the market 7.5 premium you want. But something that is half as risky, then you would want a premium that's half the size. Huh? The risk-free rate remains the same. So now you would want a return of only 8.25%. Okay, think in terms of NPV, same project, same cash flow, smaller discount rate, the NPV is now bigger. And so on. Okay. So now we have a slight little nuance with beta. So we just want to look at this formula. So let's